Ethereum has been performing badly in the market, especially against Bitcoin and Hyperliquid. Sentiment is weak, so it is a good time to revisit a bigger question. How should Ethereum actually be valued? The ETH to BTC ratio has fallen by more than 60% since early 2024, touching multi-year lows. Sentiment is weak across the board. The ETH to BTC ratio tells the story clearly, from 0.057 in early 2024 down to around 0.020 today, a steady, unrelenting decline. So the real question is, how should we value Ethereum? The first framework is revenue. Ethereum revenue mostly means gas fees, and gas fees have been trending sharply lower. After a spike in March 2024, the average transaction cost fell to near zero as Layer 2s absorbed more activity and block space capacity expanded. But lower fees are not necessarily lower demand. This is what you might call the Layer 1 champagne problem. As demand grows, engineers get better at expanding block space, so scalability can look bearish on a revenue chart even when the network is becoming more useful. The second framework is moneyness. The idea that ETH becomes money inside the Ethereum economy has been weakened by stablecoins. Stablecoin transfer volume has now clearly overtaken native ETH transfer volume on-chain. People want to transact in dollars, not ETH. Ethereum helped stablecoins grow, but stablecoins are now the main medium of exchange on-chain. Ethereum may provide the rails, but stablecoins capture a lot of the actual monetary use case. The third framework is security. The numbers make the case. DeFi TVL on Ethereum mainnet grew from under 30 billion in early 2024 to nearly 80 billion by year-end, while Layer 2 bridged value climbed in parallel. Together, they represent over $100 billion of economic activity that depends on Ethereum's security. Ethereum secures an enormous amount of value across DeFi, stablecoins, real-world assets, and increasingly the Layer 2 ecosystem. The argument here is that the value of ETH matters because it protects the network. A tiny ETH market cap securing hundreds of billions of dollars would be a serious security concern. But the market has not agreed on which framework matters most. Some people see ETH as internet money. Some see it as a productive asset generating yield. Some see it as a settlement and security layer for the global economy. Others focus on DeFi activity, Layer 2s, or Ethereum as a decentralized computer. None of these narratives are necessarily wrong. The problem is, they do not create one simple valuation story. Bitcoin has a much cleaner story. Digital gold, fixed supply, store of value, one narrative. Ethereum is more complex. It is trying to be infrastructure, money, a settlement layer, and a platform for applications all at once. That complexity is part of what makes it interesting, but it also makes ETH harder to price. The question is not whether Ethereum is useful. It clearly is. The question is, how much of that usefulness actually accrues to ETH? Until the market has a clearer answer, Ethereum may continue to trade like an asset still searching for its valuation framework.